All right, everyone, welcome back for another episode of This Week in Charts. My name is Aaron Basil via Carnivore Trades and Wall Street from Main Street. First of all, I want to say a big thanks to Jason for having me on last week. The response has been amazing. People have been engaging me on Twitter and on Facebook, everywhere else. It's been a great experience. I've been getting a lot of positive feedback, and yeah, hopefully we'll keep this thing rolling. I want to touch back on just a little bit of what I talked about last week. One of the things that I think I neglected to mention was one of the big differences that we see in this market as opposed to previous markets or of the last decade. A lot of people we've been hearing analysts and so on come and say, oh, this is going to be the top, in 2013, 2015, 2018. Oh, this is the top. We're going to go to a bear market. We're going to bear market. And they've been proven wrong every time. The one difference that I see between this market and those markets is that we have the retail investor back, and they're back in full swing. And a lot of bulls over the last decade have said, like, if the retail investor isn't back, then there's really, that's going to be like the top. That's the topping signal that we want to look for. And they're here now. I have a friend who he's not even going to work anymore because he made so much, quote unquote, so much money, probably a couple $1,000 trading Dogecoin. I mean, we have these kids like 19, 20 years old, quitting their jobs or sitting on unemployment, and they're just trading crypto all day because Elon Musk pumped it on Twitter. So we have an environment, and they're taking their stimulus checks, they're taking unemployment money, they're trading stocks with it, and they're outperforming some of the best hedge funds on Wall Street based on pure luck and just having no idea what they're doing, but being in such a bullish environment, it's working out for now. However, as we know, that sort of thing doesn't last. These sorts of trends are unsustainable. Having the retail investor in this market in the way that they are is a clear sign that we're in the late innings to me. So that's just something I wanted to touch on a little bit, as I feel like I didn't quite get to that last week. And I really think that the next time we put in a top, which I think is soon, it's not just going to be a 10% correction. I'm actually looking for a sustained, something like at least a 2018 type of a bear, where we have a sustained, 12 to 18 month bear market. So just moving on here, we're going to look over the S&P 500. Nothing really different. We kind of just went sideways this week. Tried to break out on Thursday, but really an underwhelming performance for the market, considering all big cap tech blew out earnings. Microsoft, Google, Apple, all of them had great earnings, and the market really kind of just shrugged it off. And you might say, well, why is this? Well, a lot of the, and we had great data too. We had great GDP data Friday. The thing is, all this is priced in. I mean, look at the performance here. You look at some of the stocks, Microsoft, look at the run up it's had. So you got all this stuff priced in, and really we're at this point where it's kind of as good as it gets for the market. It's more of a sell the news type event. You have great data, you have great earnings, and now it's what's left. Well, we have a lot of inflation, we have higher yields. The market's going to be forward looking, and it's always thinking 6 months ahead. So I do think that, yeah, the data is great now. We have, great earnings and so on and so forth. But what's next? I mean, we have an infrastructure bill that we already know about. That's priced in as well. So what is there? We know the reopening is happening. What else is going to excite investors to buy the market, especially at all-time highs right now? I think that as we get into May, it's going to be more clear that there's, poorer data coming out. There's going to be inflation. It's not going to be transitory. The labor market is ridiculously tight right now, and it's not getting better. They're not sending out another stimulus check, at least not right now. So I think all these things the market's kind of ignoring right now, and it can do that for a while. But at some point the market will care, and it'll be when most of the participants least expect it. So we'll just take a look here. We'll follow up again last week with the VIX here. Again, still just basing a little bit. This is what you want to see. Again, with the market kind of just going sideways, you want to see the VIX holding up and not moving lower. It is possible that, well, I see one of two scenarios here, really. One is that we're basing right now, and within the next week or so, we really, the VIX really takes off. Or I could see us having one more flush down and maybe one, so that would coincide with just one more blow off to really get all the bears out of the market. And then at that point, then we will look for the VIX to reverse and move much, much higher. One of the charts I saw that was very interesting to me this past week was this right here, average performance of the S&P 500 1 year after a recession low. So this day right here would be March 23rd, 2021. So there was 1 year after the 2020 low. And you can see as we get to about 45 days or so, that's really where it peaks out. And if you add 45 days to March 23rd, you get May 7th. So that would be coming up this week. It would be Thursday, I believe. So yeah, it's right in that wheelhouse though. The month of May is notoriously a turbulent month. It's notoriously a pivot month. And especially when you have the market trading up into it without any pullbacks. I mean, we've had pullbacks, but we haven't had a correction really since September. I mean, this is not correction. This is just a chop. This is an actual correction. This is chop. This is 5% or so. You really have to have at least 10% for it to be a legitimate correction, in my opinion. Also, I want to note the volume right now. The volume is extremely light, has been for weeks now. Whenever you have advancing price like this on declining volume, it tells you that there is not a lot of institutional participation. But notice how over the last couple of months, when we've had these sell-offs, we've had good volume. Notice the volume uptick here. This is distribution. That's institutions selling their positions. Now it takes them a few weeks to get out of their positions. They can't just sell it all at once, but they distribute in waves. So you've got, notice the volume uptick here, and they let the market go a little bit higher. Volume upticking again on the sell-off. Then they're going to let it go a little bit higher until everyone is on board, and then they unload the last of their positions. So they're just selling into retail. Retail buying is at an absolute frenzy right now. You name it, crypto, Dogecoin, Bitcoin, Tesla, all these you know, Square, the meme stocks, the Bitcoin related stocks. It's absolutely crazy right now. And yeah, you're gonna have your I think a lot of these cryptos are, I mean, they're a lot like the .coms. I mean, you're going to have your Litecoin, your Bitcoin, your Ethereum. Those will be the Amazons of the world. But you're going to have a lot of these other ones that are, you know, essentially out of business, or they're not being used because they're not going to go out of business, or crypto. But you're going to have the ones that are basically pump and dumped, and then no one ever hears of them again. So I just want to point out that volume is a very important indicator. I don't think enough traders pay attention to it. And that's also what I'm going to be looking for when to pick out the top here. On Twitter, a couple of times this past week, I noted that I was like, hey, this is some good volume. This is good, or this is excuse me, it's a good reversal. Last week we had a decent reversal, but there was no volume behind it. You know, if there's not at least over 100 million shares traded, I'm not really interested in the move. You know, if I see a sell-off on anything less than 100 million shares, it's really hard to get excited about it. I will say though, this Friday was very interesting. The fact that we were down on a Friday and the volume wasn't that high. We had average volume here, but I think this was the first Friday we actually closed negative on in like 5 weeks. And that's been a huge trend lately. Every time we have any sort of turbulence on a Wednesday or Thursday, they always save the market on a Friday. And it's just one Friday, but that is showing me that there is a little bit of a changing characteristic in this market, which leads me to my next point here. I do have a potential cycle date on May 3rd. That would be this Monday. That is something that's a proprietary technique that I use. I won't exactly share how I do it here, but I will tell you that it's based off of prior pivot points using calendar dates and trading dates and various anniversaries to calculate those cycles. So going back to the VIX scenarios I talked about here, this would line up more with scenario 1. So we have the VIX basing here, and then we would see a takeoff sometime in the next week or so. If the cycle fails, then I do see us possibly having that one more flush out that I talked about, where we have the blow off top and everybody that was bearish turns bullish, and and then immediately gets basically their heads ripped off as the market sells towards the middle part of the month. So just want to give you a little synopsis there as to what I'm looking at as far as the overall equity markets. Also, another leading indicator that I always like to look at is the semiconductors. Semiconductors are very important. They're in basically everything now. Everything's turning electric, and the semis will tell you generally with pretty good accuracy what the overall market wants to do. And the semis still have not made a new all-time high despite great earnings. And the reaction to earnings has not been good either. Look at AMD. Yeah, look at AMD here. You had the gap up after earnings, engulfing candle, and then this thing looks like a dog with fleas. You look at the weekly chart. This is all just bearish inside bar. Look, sharp move down, and you've got, boom, bear flag. Intel looks like a dog with fleas too. Look at this, gap down, and now you hit the 100 moving average, you lose that. It's probably going right back down to the 200 at 54 bucks. These semiconductors are very important, and you have NVIDIA. NVIDIA is still holding up well, but if it can't hold this 20 moving average, you might have a failed breakout on your hands. And NVIDIA doesn't report earnings for another 3 or 4 weeks, so it's not going to help the SMH overall. So I'm just noticing a lot of weakness in this sector, and with higher yields, speaking of which, again, we have here we go. Again, we have the treasuries, again, just consolidating here, just like we talked about last week. This is the 10-year, the 30-year, same kind of thing. Eventually, this is going to make a move higher. I do expect the 10-year to hit up 2.6, 2.8%, and the 30-year to touch 3% at some point this year. The government spending money like drunken sailors, they're not going to stop. And with the economy reopening, that's going to mean more inflation, and it's not going to be transitory. And as we know, tech stocks make up by far the largest portion of the S&P 500 and the NASDAQ. And they make up a large portion of the portfolios of pension funds and so on and so forth, because other sectors of the market, don't have enough growth in them to even make up for the fees that you have to pay for these funds.
So ultimately, I'm seeing a lot of problems in the equity markets for the second half of 2021 that have so far been ignored and overshadowed by the good news that we've had in the first half, looking forward to reopening, good earnings, etc. But I think that is coming to a head very soon, and that's something we're going to keep an eye on.
Right, so switching gears here, I just want to take a look at a couple of sectors that I see that are really undervalued right now. One of them is gold miners. So we're just going to take a look at the GDX. There's a lot of other things we can look at, but we'll just use the GDX. So even with gold, not that far really from all-time highs, we have gold miners close to 50% off of its all-time high. And you look at these monthly patterns here, you have this long bear base, and then we have finally got the reversal in 2016, moved up, little cup and handle, breakout, and now you've back tested the breakout level. Again, another bullish pattern here. This is just a bull flag, it's all it is. And when this breaks out, it's going to go test. Eventually, it's going to get up to probably 55, and then you get through that, you're going to all-time highs. But look at how cheap it is on a relative basis, not just to the price of gold, but to the price of all equity. The forward PE of the S&P 500 is something like 22 right now. I mean, these stocks are ridiculously undervalued. Look at the juniors. Again, breakout, and now you're back testing the 20 MA on the monthly. Look at how far this thing has to go to get back to all-time highs. If gold breaks out, these things are going to be ridiculously cheap. So I really like the gold miners right here as a short and long-term long-term play. Currently, I have wheat and precious metals as a swing trade. That's something I took. I mean, I hold these companies in like long-term portfolio, but I got in a swing trade right around 36, and I'm still holding it. I took half profits off, and I'm going to take the other half off probably on a Pierce of the 200. But these, I mean, these charts are just really good right now. Look at Sandstorm. Look at how long it consolidates for. That's telling you it's building compression like a spring, and then boom, huge breakout. So I love these charts here. Gold miners are in a really good technical position, and I think the dips and pullbacks should be accumulated. One more thing I want to talk about really briefly is someone actually mentioned to me on Twitter last week. They requested uranium. I love this. I love this chart. I think it needs to consolidate. But you see how far, again, see how far it is off of all-time highs. This is just the URA, the ETF. You are going to have a lot of resistance right around here. Oops, as we can do this right. There is resistance in these areas. So if it consolidates for a few months, I think it gets back up to 30. And then if you get through that, I mean, you're going up to 40. And then you're really going to have a tough level around 50. But point is, this is really undervalued right now. There's a lot of geopolitical stuff going on across the globe. A lot of the world is turning into, I mean, it's basically everything is electric now. Everything is using chips and all sorts of stuff. Uranium is going to be an important component moving forward as the world becomes more and more digitized and more electrified. I mean, you're looking at, what was the all-time high on this? 130. So we're trading 110 points off of that all-time high. This is a really cheap equity right now. Same thing with Cameco. If you want to have a little bit of leverage to uranium, Cameco is really the biggest and most reliable producer. But just some food for thought. I saw these charts and I said, man, these are really undervalued. So I really like gold miners here. And really like uranium long term. Not so much in the near term. I think uranium needs to consolidate quite a bit. If you look at a daily chart, it's a little extended, it's a little overbought, and it's going to run into resistance pretty shortly. But if it consolidates for a few months, this is something I think has a tremendous amount of upside. All right, so that said, thanks everybody. Take care. Hope you guys have a great weekend and a great rest of your week trading. And I will see you next week on the charts.